All right. Today is Monday, November 28th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. We're coming to you live from the City of Lights, Las Vegas. And you know, with this inflation, the City of Lights is probably paying an arm and a leg in those electricity bills. But anyways, I'm still in the Thanksgiving holiday, not back yet, so we're doing this show on tour, quote unquote. So it's gonna be short, sweet, memeless. But rest assured, I'll be back tomorrow in San Diego, and I'll be back with aggression, ladies and gentlemen. But of course, since I'm here in Las Vegas, we have forget about the thing and the other thing that was before the thing. Now, Las Vegas has the super bug. Now, I've been looking around and asking, hey, did you see that super bug? I can't see it. I can't find it anywhere. And I say, you know what? Just lay it on me. At this point, give us the super bug, who cares? But I hope everybody had a great Thanksgiving holiday. And I know some of you, your gears are not kicking back in. You're still drowsy. You're still in the holidays mood. You're still waiting for that Pepto-Bismol to kick in, right? And speaking of Pepto-Bismol, the market took a dump today, a big one. And we have plenty of theories on why that happened. Theory number one, you got your boy Jim Bullard, who came out today and said that the Fed has ways to go in interest rate hikes. In other words, don't get too excited by the 50 that is coming out in December, because we're going to keep adding on them. And Jim Bullard also came out with another blunt statement saying that the market is underestimating the chances of higher rates. And I say even the Fed is underestimating how high these rates have to go before they take inflation down. In the meantime, with interest rates moving higher and with debt racking up as the consumer continues to swipe those credit cards up and down, up and down, up and down, you saw the numbers from Black Friday, and then you got the recession force working its way in the economy as we see the pace of economic activity slowing down. And the end result of all of that, the stock market is not done crashing, and the big one is coming. And matter of fact, Douchey Bank says we see major stock market plunging 25% from the levels somewhat above today's, meaning we're not done yet. And Douchey Bank, they're not really that crazy. You look at the chart of the SPX, the S&P 500, a monthly chart, we have a trend that goes all the way back to the '09 bottom. You really think that we're not going to go back and revisit this line at least, if not even crack below it? And if we do, that will be a decline from this point on of about 23%, assuming that we're going to hit this trend line by May 23. But of course, the other theory in why the market plunged today is the news that we're getting out of China. And this is, of course, in reaction to the draconian lockdowns due to the thing. I don't know why they're locking down at this point. I don't know why I have to go to the clinic and have my mask on. And then when I meet the doctor, he says, take your mask off. But anyways, it's a big deal in China. And now people have reached the limits. And now they're boiling up and they're saying to hell with it. We're not going to be silenced anymore. We're not going to have you push us around and tell us what to do. There is no point of doing this anymore. And of course, they're being really creative, using blank white papers, using memes, and they're winning the heart of the world. You see, ladies and gentlemen, freedom is inherent. Everybody seeks freedom. And when you try to take that away in such draconian and tyrannical fashion, you're going to get a reaction. People are going to reach the limits and say enough is enough. And perhaps we're reaching this point in China right now. Despite the propaganda, despite the threats of your social credit score might go down, people have reached the limits. And of course, the US came out criticizing China's zero thing strategy. I almost said it, but who are you to say this? These are the same people, by the way, the government and the sheepies on Twitter and social media, the mob, bullying everybody who has a different opinion. They wanted us to lose our jobs for not taking the jab. They wanted to lock down the country forever. And now that they're proven they're wrong, they don't come back and apologize. Hey, sorry folks, we got it wrong. We overreacted. No, crickets, nothing at all. But maybe you should look to your role model in China. And while you're at it, maybe you should move over there. But anyhow, don't get me started here. You know what? Never mind. Get me started. You know why? Because we have, with all of what's going on in China right now, guess which company, which American company that is now supporting the Chinese regime. And if you said DI mob Apple, you're 100% right. Matter of fact, the headline reads, Apple restricted airdrop capabilities in China ahead of the anti-government protests, leaving dissenters without key communication tools as demonstrations spread. So once again, Apple, you know, the same company that lecture us about wokeism and save democracy, well, they're supporting the government in China against the people. And this doesn't come as a surprise because the Chinese government has been doing favors to Apple, and Apple is returning the favors. It's a transactional deal. Apple doesn't believe in anything at all. Wokeism, democracy, that doesn't matter. They don't believe, Tim Apple and company don't believe in anything at all except money. But the most important take here, the market, is it's not just the problems in China. For Apple, we're now getting news that iPhone demand is actually going down. Now you add the turmoil in China on top of that, and you got a major problem. And now Apple is facing a deficit of about 6 million iPhone Pros. They're not going to be able to sell that in the fourth quarter as they anticipated. We know that Apple is the market, and the market is Apple. And there is this myth that kept Apple outperforming and perhaps prevented the entire market from crashing. And this myth is, yeah, everything can be bad, but Apple is the shining city on a hill. Apple will be immune from the recession, from inflation, from whatever. And they got an insane mountain of cash, and they're going to use it in share buybacks. So if there is anything to buy, is Apple in this lousy market. And if there is anything to hold in your portfolio and not panic and sell, it's Apple, because the almighty Apple. You don't sell Apple. And now this myth is being challenged. And little by little, more and more bad news will come against Apple, and little by little, the faith will be shaken. We will start to see a contagion of selling in this stock. When this stock goes down, the entire market is going down with it. We've been talking, folks, about the recession theme recently in the stock market, where we're seeing tech going down big. We're now even seeing energy underperforming and moving down, which is yet another sign that the market is shifting into the recession mode. We're seeing bonds outperforming. We're seeing healthcare, defensives, utilities outperforming. This is a market that is now dabbling into the recession mood. It is not fully there yet. We need to see more evidence. We need to see more data that the market is indeed shifting to that mentality. And if that is the case, we have a whole different playbook that we have to follow. And I gave you a little teaser last week. But what we're seeing right now, oil was down big in the morning, and we have technical damage in the charts of oil. And if that is the case, the market is saying, hey, the recession is coming. We're nearing. And if the rally in energy stops and starts to go down, that will mark the end of the so-called bull market. In reality, it's a cocaine-fueled market, courtesy of the quantitative easing policy by the Fed. But a crash in energy right now will officially mark the end of this so-called bull market since 2009. And here comes the recession. And if you have time, and maybe you should have time, you should watch these videos that I produced before. Video number 1, the title is this the initial shock? Or the stock market crash? And I'll go back to the 2008 example. And back in that video, I told you, I don't think that this is the crash. I think this is the initial shock, and the crash is coming. And maybe we're nearing the beginning of this crash. Video number 2, wishing for oil prices to crash? Be careful what you wish for. And in that video, I showed you in details why a crash in oil will not mark the end of inflation, but it will mark the beginning of the recession. And we are already getting a lot of signs here. For example, if you look at the bond market, you're going to see a lot of momentum in the recession trade. And even the stock market is showing a lot of momentum for the recession trade, in which the most boring consumer defensive names, utilities, some REITs, the big pharma names tend to outperform. And tech and energy, but specifically energy, goes down big. Now, the reason why I'm not ready yet to say, hey folks, it is official. The market is saying the recession has begun. We should short energy instead of being long. I'm not ready to say that yet, and the reason is, what if the reaction we're seeing in oil right now is in response to what's going on in China? Maybe wishful thinking from my part, but we also have some tailwinds still alive in the energy trade. Among them, the price cap on Russian oil, even though that's another fiasco. The EU failed to agree on the Russian oil price cap. So much for unity, right? Our European allies are united. Okay, let's see how united they're gonna be when they start to freeze their nuts. And we also have yet to see the response from OPEC+. Are they gonna cut the output? By how much? But again, that will not matter if we see clear signs that the global economy is heading into a recession. We see it in Europe. We're starting to see signs here in the United States, but not definitive signs yet. And therefore, I'm not ready to say, hey, folks, it is official. Short energy, here comes the recession. But I'm starting to see more and more and more evidence for this case. With that being said, it is still premature to make that call. And of course, perhaps adding pressure on energy instead of the recession force. How about the policy from the administration of allowing Venezuela to produce more oil? To protect democracy, we have to help some dictatorships. So again, to recap, the underperformance by energy is extremely alarming. And it would be extremely alarming if the reason is that the market is shifting into the recession mode. But for now, we have a lot of noise, a lot of headwinds besides the recession. Among them, what's going on in China, the output increase from Venezuela. But if that is proven to be noise and the actual headwind pushing oil down is the recession force, then run for the hills. And we have a new whole strategy in investing, which we kind of talked about in previous videos, just a little teaser. But if I see these signs becoming clear, we'll talk about the strategies on how to deal with a market that is in a recession mode. But until then, let's talk about what happened in the market today. We begin with the closing of the indices, and here we go. The Dow Industrial Average down by 497.57 points, or a decline of 1.45%. The Nasdaq leading the pack to the downside by 176.86 points, or a decline of 1.58%. The S&P down by 62.18 points, or a decline of 1.54%. When we look at these sectors' performances today, shame on all of them. They're all down in the red, but you can see the outperformers. The recession theme once again. Defensives, healthcare, utilities, consumer cyclicals, of course. It shows that because of the Chinese names, but actual cyclicals were underperformers. So yet again, we have another recession theme in the market happening today. When it comes to the advance to decline ratios, the NYSE 12% advancing versus 88% declining. The Nasdaq 22% advancing versus 76% declining. When it comes to commodities, look at this. In the morning, it was doom and gloom for energy. The WTI, Brent were down big. And then we got a reaction. The dip buyers did show up, and we saw the WTI actually closing positive by almost 1%. Brent was down about 0.75%, but again, a big comeback for oil. And therefore, I say, I'm not 100% comfortable of making a call that we should short oil and energy right now because of the recession theme. For now, we're seeing some fighting back. We're seeing some noise that could cloud our judgment here. So therefore, I continue to be long energy, but I do have protection. I do have puts. I lighten up on my energy holdings. Instead of having 6-7 names, I'm now down to 3. Actually 4. I'm trying to get rid of one, but the goal is to stick to 3. However, if the market definitively shows that it is in a recession mode right now, then we have no other choice but to get out and actually short energy. With that being said, the gasoline was down about 2.5%, heating oil was down almost 3%, and the party boy was pretty much on the flat line. Now, when it comes to softs, the crash in coffee continues, down yet another 3.25% or so. And then we have OJ down about 2%, and cotton futures down almost 1.75%. Cocoa and lumber flattish for the day, although sugar managed to close moderately in the green by about 0.5 percentage point. Now the dollar was up, and therefore we see metals down, gold down, silver down big, almost 2.5%. Copper down almost 1%. Yet we see a positive reaction for platinum and palladium for now. Meats down across the board, led by lean hogs, losing almost 4% of its value today, followed by feeder cattle futures, which lost about 0.75% today. When it comes to grains, we have some gains here, be it modest ones, led by soybean oil, closing with about 2% worth of gains today. And then we have more gains for soybeans and soybean meal, canola. Yet wheat futures continue to be the underperformer, down yet another 2% today. Rough rice was down, oats down. On the other hand, corn closing pretty much in the flat line. On to the big casino, the options market. What's going on here? The volume is coming back, but it's going to take a while. The volume at least came back for Tesla and Apple. It has yet to show up in Nvidia, Microsoft, and the rest of them. In any case, the hottest table by far was Tesla, at around 1.6 million contracts traded today. About 56.5% of those were calls. Apple at number 2, with around 1 million contracts traded today. Look at this. About 55% of the volume was puts, not calls. Therefore, we see Apple down, yet Tesla traded in the green, because folks are buying more calls in Tesla, but they're buying more puts in Apple, indicating that we've seen a lot of pain in Tesla, and maybe now it's Apple's turn. Anyhow, Amazon at number 3 at around 750,000 contracts traded today. About 68% of those were calls. On to the unusual activities that took place in the options market today. Let's start with the XLE. This is the energy ETF, and you can read this in many ways. It could be somebody not sure where energy is going to go in the next few months, but they know there is a major move coming. It could be up, it could be down, and therefore they're buying out of the money calls and out of the money puts. But in reality, I see it as somebody who holds the XLE and they're looking for insurance. in case we see a crash in oil. What they're doing here is they're selling the 98 calls for the XLE, and they're using that money to buy the $70 puts with the expiration date of February 17th. Now, they received about $2.50 a piece from selling the 98 calls, and they paid around $1 a piece for buying the $70 puts. And all in all, by using this strategy, they actually have a credit worth about $1.50. So they're not paying for this trade. They sold the calls, they used this money to buy some puts, and they're sitting on some cash. And that cash is worth about $3 million. And then what about the EWZ, the Brazilian ETF? Somebody sees more downside coming here, and they bought the 26.5 puts for the expiration date, December 30, with expectations that the EWZ could move down and lose more than 10.5% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $1.6 million. And then what about EQT, another name that I own, but if energy goes down, it will go down along with it, despite all of these good tailwinds. Too early to say, as I said before, but what is the harm in buying some insurance now? And perhaps this is what this trader is doing in this trade. They bought the 34 puts for the expiration date, January 20, with expectations that EQT could go down and lose more than 18% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $600,000. And then what about the ticker NVDA NVIDIA? Somebody's betting on a short-term upside here by buying the 167.5 calls for the expiration date, December 16, with expectations that NVIDIA could rebound and gain more than 6% by then. They paid around $3.80 a piece to enter this trade, all in all spending around $600,000. And lastly, at the bottom of the table, what about the ticker CRM Salesforce? Somebody sees more downside coming, maybe protection if they hold the stock, and they bought the 145 puts, all for the expiration date of December 2nd, meaning this upcoming Friday. And the expectations are that CRM could move down and lose more than 5.5% of its value by then. They paid around $2.70 a piece to enter this trade, all in all spending around $1.3 million. On to the heat map. What do we see here? A bloodbath across the board. The exceptions, number one, the Chinese names. They're acting jittery. They were up big, then they went down to the flat line. Forget about them for now. Amazon, that's due to buying of a lot of calls. It is a mechanical reason, but the all-in-all theme is the market is suffering. And what is outperforming? Big pharma healthcare, the consumer defensive names. In other words, we have a recession theme going on. Look at the ticker BUD, Budweiser. We talked about this as one of the recession picks, and it is outperforming today. So again, the market remains in a recession theme. But we have a lot of macro data coming that could reignite the inflation theme, that could give hope to the expansion theme, aka the soft landing theme. A lot of things could change this week. But it is clear the market is thinking about it. The market is testing it. The market is dabbling with it. What are we talking about here? We're talking about the recession theme. We're getting closer and closer and closer by the day. On to the heat map for the ETFs. Again, a bloodbath across the board. But notice the outperformers. XLP. What is that? Consumer defensives. The consumer staples. XLU down about 1%, but outperforming energy. Certainly outperforming tech. That's recessionary. XLU for utilities. And then you got the XLV, healthcare. These are the big pharma names. Yes, in the red, but outperforming. Look at the TLT in the green today. And all of these are leading indicators that the market is heading into the recession theme. If not, it's already in it. Now, let's see if the charts agree and show us that perhaps this bear market is ending, and down we go. We start with the SPY, the S&P 500, 30 minutes chart. What do we see here? Yesterday, we talked about how, yes, we're seeing a bull flag pattern, but it came in a shortened trading week, a holiday week, with very anemic volume. So we cannot take it seriously. If anything, when the volume comes back into the market, the reaction will be to the downside. And this is exactly what we got today. We got a flush down, a gap down right away, and the flush down did not stop all the way till the end of the day. And now the chart lost 398 as support, but look at where the RSI is reading. It is oversold. So of course we got a rebound by the end of the day, and this rebound could continue and go all the way in a retest to 398 as resistance this time around. But pay attention now. If it gets rejected again from 398, then that would be a sign to double down in the shorts, because in all likelihood the next stop would be all the way down at 385. When we switch to the daily chart for the futures contract for the S&P 500, the continuous contract, the bull flag pattern played out for about 3 days, but it's now reversing. Do we have a confirmation? The answer is not really. For one, the support of 3,960 remains intact. We don't have a crossing in the MACD yet, keyword yet, and of course we see the reaction once the volume showed up back in the market. The reaction was negative, but the confirmation that a reversal is in the making if we see the chart losing 3,960. Because look at this. When we zoom in to a 30 minutes chart, what do we see here? We got a rebound exactly from 3,960. If that holds, so far so good for the bulls. But if that is lost again, the bears are going to get excited. The short bits will start to mount. Next thing you know, we're back at the June bottom. What about the Qs? 30 minutes chart for the NASDAQ. Yesterday, we talked about the contrast between the SPY and the Qs. The SPY showing a bull flag pattern, the Qs showing a bear flag pattern. And I said, can the SPY really rally without technology? Impossible. And what we see here is a flush down in the morning, forming yet another bear flag, and then finally losing the support of 284.26. Now it is getting a little oversold on the RSI, so we could see a reaction and a retest to 284.26 as resistance this time around, but a failure to recapture it as support would be a sign to double down on the shorts. Because the next stop would be 280. 280 is not going to hold, and down we go all the way to at least 269.29. When we look at the continuous contract, the daily chart for the NASDAQ, what do we see here? The bull flag was a lot weaker than the SPY's bull flag, and now it appears that it has already reversed. For one thing, the support of 11,689 is gone. But do we have a confirmation from the MACD? Of course not. I'm a conservative trader, and yes, the MACD is a lagging indicator, but once it gives you the confirmation, at least you can have the comfort of mind that you do have a confirmation, be it a lagging confirmation. When we look at the IWM 30 minutes chart, what's going on here? A gap down, it lost 183.25 as support. But look at the RSI, same story. We could see a retest to 183.25 as resistance this time around. If there is a failure, there's not a lot of support between here and 174.22. Unlike the SPY and the Qs, both have some support. This chart doesn't have a lot of support until all the way to 174.22, which will make an excellent short trade. But if it does make it above 183.25, then we will see a rally all the way to closing the gap. And if that is successful, it goes all the way back to 188. Which outcome holds more weight right now? The answer is the bearish outlook, which says perhaps a rebound all the way to 183.25, then yet another failure, and down we go to 174.22. And perhaps a supportive evidence to all of that is the chart of the Dixie, the dollar index. This is a daily chart. Yesterday we talked about the prospects of a double bottom here, and so far, so good. It appears that we have a double bottom formation in the making. We see the RSI firming up, but still in negative divergence. We see the MACD firming up, but still no confirmation that the bearish momentum is over. So yes, we're seeing signs that the bear market rally is reaching an end. But do we have a confirmation? The answer is not yet. When we look at gold, yesterday we talked about gold as a confirmation for the dollar. And perhaps what we're seeing in gold is a reverse ABC pattern, which will take us all the way down to 1,685. And if that is the case, the double bottom in the dollar is going to hold. And we already have a confirmation in gold. We don't have a confirmation in the dollar that the double bottom is for real, but we have a confirmation in the leading indicator of the dollar, gold. We have a confirmation of what? Of the weakness. We have negative divergence on the RSI. We have a crossing in the MACD. In other words, the case for a double bottom in the dollar is getting really, really strong. And here is the weekly chart for Brent oil. Why am I showing the weekly, not the daily? Because I'm looking at 85. And I'm looking at the MACD indicator. For now, oil bears are winning, technically speaking, because we have a crossing in the MACD indicator that was met by failure, and now we're seeing it turning around, producing more indicators for bearish momentum. If that is the case, we could see a massive flush down in oil here. But I am hesitant, and market participants are also hesitant of going bearish against oil and energy right now, and therefore the chart continues to hold on at around 85 for support. But how long can it hold? What piece of data, what piece of evidence will make me and market participants say, okay, the recession is here, forget about energy, it's time to dump, it's time to go short? If that happens, the flush down comes. Absent of that, oil bulls still have some hope here that we could see a reaction from OPEC Plus, that we could see something going on with the Russia price caps, that perhaps the downward pressure on oil prices is happening from what's going on in China, and not actual recession fears. But again, let's be honest here. Who has the upper hand right now looking at this chart? The answer is oil bears, not oil bulls. And here is the daily chart for the 10-year yield. What do we see here? The destination for now is 3.5, but we're seeing more signs that the 10-year yield is ready to move higher from this point on without visiting 3.5. Why am I saying this? Look at the RSI firming up a little bit. The MACD, similar story here. But if we zoom in to, let's say, a 15 minutes chart, is what we're seeing right now a formation of a saucer bottom? If that is the case, we will see the 10-year moving higher again, perhaps in a big way. So watch out here. You saw what happened in the VIX today, and that could be the case in the 10-year soon. Here's the TLT, a daily chart. Again, above the resistance zone, above 100.28. So far, so good, but is it gonna pull down? And is there a scenario where the TLT moves higher and we see the 10-year also moving higher? Possible, but it would be a message, a confirmation of the recession theme. Yields are moving higher because the Fed will go higher, and the TLT is moving higher because of the recession theme, because we have more demand in buying bonds right now. Of course, at some point, this divergence is not going to hold, and if the recession theme wins, we will see the TLT moving higher, and the 10-year, we're talking about the yield right now, having a hard time rallying higher. But again, a confirmation of that theory would be the short end of the yield curve blasting higher, the long end struggling to move higher. And the reason is we have demand in buying long-term bonds as safety, as shelter from the recession. What about the VIX? 4 hours chart. What's going on here? Look at this. We're waiting and waiting for 20. But the VIX says, maybe I'm not going to wait for 20. Maybe I'm ready to pop right now. We see a massive pop forming what? A bull flag pattern with positive momentum on the MACD indicator, suggesting that perhaps the VIX is ready to move higher and it is bottoming right now. Maybe already bottomed. But why did the VIX rally before hitting 20 exactly? The reason is I'm waiting for 20. You're waiting for 20. Everybody's waiting for 20. And when everybody's waiting for 20, some traders want to catch the trade ahead of time, and we see the move happening before hitting this threshold of 20 because people going long the volatility index by buying puts on the SPY before 20 is hit. We see the VIX bottoming before 20, and that happens all the time. And therefore, a lot of technical analysts use zones instead of actual numbers because a lot of traders want to get in the trade early on. They don't want to miss it out. They don't want to wait for it to happen. And when this mentality takes over, we see stocks reacting before the important numbers. In this case, the VIX is not a stock, but it is a chart. What about Apple? 30 minutes chart. What's going on here? We talked about the weakness in Apple, the no entry zone. You cannot get above 150. Every time it gets above 150, whack them all. You short, you close your eyes, you short, and it goes down again. And now it went down, forming yet another bear flag at around 145. And it lost that support by the end of the day. Not a good look for Apple. If it's not a good look for Apple, it's not going to be a good look for the entirety of the market. What about Tesla, the souffle, 30 minutes chart, or 15? Let's do 15 because last time we talked about the saucer bottoming formation. What do you know? Tesla blasted higher. And yesterday I talked about the resistance of the top of the flush down candle. And Tesla faced that resistance, forming a bear flag pattern. And the bear flag did play out in the morning by a gap down, but immediately the buyers did buy the dip and we saw Tesla moving higher. Now, how do we see it? How do we look at it? Number one, is this the beginning of a head and shoulder formation and down it goes from here? Maybe, but not so fast. You know why? Because we still have a trend line and this trend line is intact, at least for now. If it is broken, then down we go, and the head and shoulder formation plays out. What about Bitcoin? 4 hours chart. What's going on here? We have the break below the bear flag consolidation pattern, and then we have a move higher, consolidation for a little while, but the chart broke the consolidation range to the downside. And now is it forming a bear flag pattern? Too early to say, but if that is the case, and I always believe that it is the case, that we're going down all the way to 15,000. And then we'll talk. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the Case-Shiller Home Price Index. This is a lagging indicator, but it is important. And then we have the Consumer Price Index. And most importantly, we have Team USA playing tomorrow against Iran. Now, can you imagine if we lose to Iran and we get eliminated? The humiliation. So winning is the only acceptable outcome. We'll see what happens. But for now, go Team USA. And with that, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Take care.
In Stone Cell, and
what is this?
that is my life, and nothing, nobody can stop me from making that happen.
No one really late, but